Hello everyone, and welcome to part 2 of the Week 4 live chat for Finance 4424 Case Studies in Finance. Today we'll be discussing your final essay project, which focuses on analyzing ExxonMobil's recent strategic challenges and opportunities. This project will require a detailed examination of financial ratios, industry trends, and strategic decision-making from the perspective of ExxonMobil's leadership. Let's walk through some of the key components and expectations for this case study. In this project, you will assume the role of ExxonMobil's CEO presenting to the board of directors. Recently, ExxonMobil's board has seen significant changes with 3 new ESG-friendly members. This shift may influence how the company approaches future investments, including traditional drilling, clean energy technology, or using profits for dividends and share buybacks. Your analysis should evaluate the best strategy for ExxonMobil's stakeholders, considering these new dynamics. Understanding ESG, environmental, social, and governance, is crucial when considering strategic shifts for a company like ExxonMobil, especially with the recent changes in the board's composition. ESG factors influence how companies balance their responsibilities to shareholders, the environment, employees, and society at large. For ExxonMobil, these factors have become increasingly significant given the pressure to adopt more suitable practices. Now that 3 new ESG-friendly members have joined the board, it's possible that the company's strategic direction may change. This could mean a shift away from traditional fossil fuel investments toward newer areas like clean energy technology. For example, the board might weigh the benefits of expanding investments in carbon capture, renewable energy sources, or alternative fuels. Alternatively, the board could decide to continue focusing on more traditional activities, such as further investments in oil and gas drilling. This approach may appeal to stakeholders looking for immediate returns, but could face criticism from investors and consumers with a preference for sustainability. Another key consideration is how ExxonMobil might allocate its profits. Should the company prioritize increasing dividends to investors or using excess cash for share repurchase programs? Both strategies offer benefits, but the new board's perspective on ESG priorities might influence the decision toward a more balanced approach that considers long-term sustainability alongside shareholder value. In this context, it is crucial to think about how these strategic decisions align with the interests of different stakeholder groups, including shareholders, employees, and environmental advocates. The new board composition has the potential to significantly influence ExxonMobil's direction, affecting the company's long-term outlook and positioning in the evolving energy market. For the final project, your analysis will lead to recommended strategies that you, as the CEO, would present to ExxonMobil's board. This includes a comprehensive evaluation of several critical factors that will shape the company's direction for the coming years. Begin with a summary of ExxonMobil's current operations and outlook for the future. This part of the project should provide an overview of how ExxonMobil generates revenue today and what the future might hold given market trends, technological advances, and changes in global energy demand. Consider how ExxonMobil's position in the traditional fossil fuel market might evolve as it explores opportunities in renewable energy or other sustainable technologies. Highlight any recent projects, investments, or partnerships that are shaping its future trajectory. Next, analyze the competitive and legal situation that ExxonMobil faces. This includes examining how industry competition, market positioning, and regulatory pressures impact the company's strategic options. For instance, New regulations aimed at reducing carbon emissions could influence ExxonMobil's approach to investing in clean energy or maintaining its core oil and gas operations. Consider how legal challenges or compliance requirements might affect the company's future cash flows and overall profitability. Pay close attention to how competitive dynamics and regulatory shifts could either present risks or open up opportunities for ExxonMobil. How does this environment compare to that faced by its competitors, such as Chevron? This analysis will help in understanding how external factors could influence the financial performance and strategic choices for ExxonMobil in the short and long term. A crucial part of your analysis is the comparison between dividend payments and share repurchase programs, two primary methods of returning capital to shareholders. Start by explaining the difference between these strategies. Dividend payments provide shareholders with a regular income stream, making the stock attractive to income-focused investors. In contrast, share repurchases reduce the total number of shares outstanding, potentially increasing the stock's value and offering a more tax-efficient way of returning capital to shareholders. Discuss which strategy is better for shareholders given ExxonMobil's current financial situation and market conditions. Consider questions like, are dividends more attractive due to their stability? Or would buybacks create more value in the long run by boosting earnings per share? Look into ExxonMobil's recent strategies in this area and analyze how they have impacted shareholder returns. Think about how the new board's ESG focus might influence future decisions between these two options. Wrap up your analysis with a summary and conclusion, tying together the findings from your ratio analysis, strategic recommendations, and assessments of market conditions. Your goal is to present a cohesive strategy that aligns with the company's strengths while also addressing potential challenges. Finally, remember to include a properly formatted APA reference list to document the sources you used for your research. This is critical for ensuring academic integrity and supporting the credibility of your analysis. Also, make sure that for every reference you include at least one in-text citation, and for every in-text citation there should be exactly one reference in the reference list. Let's discuss the different types of financial ratios. Each category provides unique insights into a company's financial health. Liquidity ratios, like the current and quick ratios, assess the company's ability to meet short-term obligations. Activity ratios, such as the return on equity and asset turnover, measure operational efficiency. Debt ratios provide insights into leverage and long-term financial risk. Profitability ratios assess how effectively the company is generating profits from its operations. Use this framework to interpret your findings on Exxon and its chief competitor, Chevron. Liquidity ratios help assess a company's ability to meet short-term obligations without the need for external financing. Liquidity ratios are critical for assessing a company's short-term financial health and its ability to meet current debt commitments without relying on external funding sources. These ratios help determine whether a company has sufficient resources to cover its liabilities, which are due within the next year. Understanding liquidity is essential for both managers and investors, as it reflects the company's ability to manage its operations smoothly, even in times of financial stress. The two primary liquidity ratios are the current ratio and the quick ratio, each offering a different perspective on the company's financial flexibility. Current ratio. The current ratio measures a company's capacity to pay off its short-term liabilities with its total current assets. It includes all assets that can be converted to cash within a year, such as cash, accounts receivable, and inventory. The formula for the current ratio is current ratio equals current assets divided by current liabilities. A higher current ratio indicates that the company has more than enough assets to cover its short-term obligations, which can provide a margin of safety during periods of financial uncertainty. However, an excessively high current ratio could also suggest that the company is not utilizing its assets efficiently to generate returns. For ExxonMobil, analyzing the current ratio over the last 3 years will help us understand how well the company manages its working capital. Comparing this ratio to Chevron's could reveal how each company positions itself in terms of short-term liquidity management. Quick ratio. The quick ratio, also known as the acid test ratio, offers a more conservative view of liquidity. It focuses on the most liquid assets, those that can be quickly converted into cash, by excluding inventories and prepaid expenses from current assets. The formula for the quick ratio is quick ratio equals the difference between current assets and inventory and prepaid expenses, and that figure divided by current liabilities. By excluding inventory, the quick ratio provides insight into a company's ability to meet short-term obligations without relying on the sale of its inventory, which can be particularly important for industries where inventory may not be quickly sold, such as with energy. For ExxonMobil, the quick ratio can help identify how effectively it can manage cash flow when immediate obligations arise. A comparison with Chevron's quick ratio will provide a clearer picture of which company is better positioned to handle short-term liquidity challenges, especially during periods of market volatility or unexpected shifts in demand. In your analysis, look at how these ratios have changed for ExxonMobil over the past 3 years. Are they trending upward, which would indicate improved liquidity, or are they declining, which might signal potential cash flow challenges? Compare these trends with Chevron's performance, and this can reveal competitive strengths or weaknesses in how each company manages its short-term financial stability. These insights will be crucial when making recommendations to the board regarding strategic decisions like capital allocation and potential investments. Activity ratios, such as the return on equity and asset turnover, help evaluate how effectively a company utilizes its assets to generate revenue. A high ROE could suggest that ExxonMobil is generating substantial returns from shareholder investments. Analyze whether Exxon or Chevron has more efficient asset utilization and what this could mean for their strategic decisions, especially considering Exxon's potential shifts toward cleaner energy investments. Activity ratios, also known as efficiency ratios, are essential for understanding how effectively a company uses its assets to generate revenue and manage operations. These ratios provide insights into a company's ability to convert different asset categories into sales or cash, which directly impacts its operational performance and overall financial health. Return on equity, or ROE. ROE measures the company's ability to generate profit from shareholders' equity. It is calculated as net income divided by shareholders' equity. A high ROE indicates that the company is efficient at generating earnings relative to equity invested by shareholders. This can be a positive signal to investors, suggesting that the company can provide attractive returns without needing additional equity capital. For ExxonMobil, a strong ROE might reflect its ability to generate profits even in a challenging industry environment. Comparing Exxon's ROE with that of Chevron helps to assess which company is making more effective use of shareholder investments. It's important to consider the impact of leverage on ROE, as higher debt levels can boost ROE by increasing net income through greater investment in assets, but it also increases financial risk. Asset turnover ratio. The asset turnover ratio measures how efficiently a company uses its total assets to generate revenue. The formula is revenue divided by total assets. This ratio is a key indicator of a company's operational efficiency. A higher asset turnover ratio suggests that the company is making good use of its assets to produce sales, while a lower ratio could indicate underutilized assets. In the energy sector, where capital investment is quite substantial, this ratio can reveal how well ExxonMobil and Chevron are utilizing their large asset bases to drive sales. When analyzing this ratio, consider whether changes are due to shifts in revenue generation or fluctuation in asset levels, such as investments in new facilities or divestment of assets. When conducting your analysis, focus not only on the numerical values of these ratios, but also on the trends over the past 3 years. Are ROE and asset turnover improving, suggesting greater efficiency and profitability, or are they declining, indicating potential challenges in maintaining operational effectiveness? Comparing ExxonMobil's activity ratios with those of Chevron can reveal competitive advantages or areas where one company might be lagging. For example, if ExxonMobil's asset turnover is lower than Chevron's, it may need to assess whether its assets are being used optimally or if changes in its investment strategy are required. Understanding these ratios will be crucial in forming your strategic recommendations to the board, as they provide insight into how effectively ExxonMobil is using its resources to generate shareholder value and maintain competitiveness in a rapidly changing energy market. Debt ratios measure the proportion of a company's assets that are financed by debt. This can indicate financial risk and the company's leverage. In an industry like oil and gas, debt management is critical due to high capital expenditure needs. A higher debt ratio might suggest greater risk, especially if interest rates rise. Compare Exxon's debt ratio to Chevron's and consider how these companies manage their long-term debt obligations. The debt ratio is a critical measure of a company's financial leverage, showing the proportion of its assets that are financed through debt. It is a simple yet powerful indicator of a company's risk profile, providing insights into how reliant the company is on borrowed funds. The formula for calculating the debt ratio is simply total debt divided by total assets. It can be expressed as either a decimal or a percentage, representing the proportion of the company's assets that are financed through debt. For example, a debt ratio of 0.5 or 50% indicates that half of the company's assets are funded by debt, while the other half is financed through equity. Interpretation of the debt ratio. A higher debt ratio suggests that a company is using a larger portion of debt to finance its assets. While this might indicate an aggressive growth strategy, it also implies higher financial risk. If a company relies heavily on debt, it must generate sufficient cash flow to meet interest payments and principal repayments, especially if interest rates rise or market conditions become worse. A lower debt ratio indicates that a company is less reliant on debt, suggesting a more conservative approach to financing. This can be beneficial in periods of economic uncertainty as it lowers the company's financial risk and reduces the burden of fixed debt payments. Application in the energy sector. In capital-intensive industries like energy, companies often maintain relatively high debt ratios due to significant investments in infrastructure, exploration, and production activities. However, a high debt ratio makes companies like ExxonMobil and Chevron more sensitive to changes in interest rates and market conditions, such as fluctuations in oil prices. For ExxonMobil, examining the debt ratio over the past 3 years helps us understand how its financing strategy has evolved. Did the company take on more debt to fund new projects or to maintain operations during periods of lower oil prices? Or did it reduce debt to strengthen its balance sheet and lower financial risk? Comparing ExxonMobil's debt ratio to that of its competitor Chevron is essential for understanding relative leverage. A higher debt ratio compared to Chevron might suggest that ExxonMobil is pursuing a more aggressive growth strategy, but at potentially higher risk. A lower debt ratio could indicate a more conservative approach to managing debt and prioritizing financial stability. Key considerations for strategic recommendations. Understanding the debt ratio is crucial when making strategic recommendations to ExxonMobil's board. A high debt ratio may limit the company's ability to take on new debt for future investments, such as expanding renewable energy initiatives or maintaining dividend payments during periods of lower profitability. Conversely, a lower debt ratio could provide ExxonMobil with more flexibility to pursue new investment opportunities, secure additional financing, or to withstand economic downturns. As you analyze the debt ratio for ExxonMobil and Chevron, consider the broader implications for their financial strategies. How does their approach to debt financing align with their long-term goals, such as transitioning to clean energy or maximizing shareholder returns? These insights will be vital when you present your strategic recommendations to the board. Profitability ratios such as net profit margin, operating margin, and return on assets, or ROA, assess how effectively the company converts sales into profit. For ExxonMobil, analyzing changes in these ratios over the past 3 years can help determine how well the company has managed costs and adapted to market changes. Consider how ExxonMobil's profitability compares to Chevron's and how this influences decisions about dividends or stock buybacks. Profitability ratios are critical indicators of a company's ability to generate profit relative to various aspects of its operations, such as revenue, costs, assets, or shareholders' equity. These ratios provide insights into how efficiently a company can convert sales into profit, manage its expenses, and utilize its assets to create value for shareholders. These ratios fall into 2 main categories: margin ratios, which focus on the efficiency of converting sales into profit, and return ratios, which evaluate the company's effectiveness in generating returns for shareholders based on invested funds. Understanding and analyzing these ratios will help you assess how well ExxonMobil is performing in comparison to Chevron, as well as the overall profitability trends over the past 3 years. Gross margin, as shown on the slide, the formula is a combination of revenue minus cost of goods sold. Take that amount, divide by revenue, and then multiply by 100. The gross margin measures the percentage of revenue that exceeds the cost of goods sold, abbreviated as COGS or COGS. It indicates how efficiently a company is producing and selling its products. A higher gross margin suggests that ExxonMobil is better at managing production costs relative to its sales, which is particularly important in the energy industry where cost of extraction and refining can be significant. Comparing ExxonMobil's gross margin with Chevron's helps to determine which company has a competitive edge when it comes to cost management. Net profit margin. This is an easy calculation. It is simply net income divided by total revenue. The net profit margin reflects the proportion of revenue that remains after all expenses, taxes, and costs have been deducted. It is a key indicator of overall profitability. A higher net profit margin means ExxonMobil retains more profit from each dollar of revenue, which can be a sign of effective cost control or higher pricing power. Analyze whether ExxonMobil's net profit margin is increasing, which indicates improved profitability, or if it is declining, potentially due to higher operational costs or decreased revenue. Operating margin. The formula for operating margin is simply operating earnings over revenue, which can also be expressed as cost of goods sold plus administrative expenses divided by revenue. The operating margin shows the percentage of revenue remaining after covering operating expenses such as cost of goods sold and those administrative costs. It provides insights into how well ExxonMobil manages its core business operations. A higher operating margin suggests more efficient operations and cost management, allowing the company to maintain profitability even during market fluctuations. This ratio is particularly useful for comparing ExxonMobil's operational efficiency with that of Chevron, helping you understand which company is better positioned to weather changes in the industry. Return on assets, or ROA. Also a simple formula. Net income divided by total assets equals ROA. ROA measures how effectively a company uses its assets to generate profit. It gives an indication of the efficiency of management in utilizing the company's asset base. A higher ROA means that ExxonMobil is generating more profit per dollar of assets, which is crucial in capital-intensive industries like energy. Compare ExxonMobil's ROA with Chevron's, and this will reveal which company is better at converting its investments into profitable returns, providing a clearer picture of operational efficiency. Return on equity, or ROE. This metric was discussed earlier under activity ratios. It measures the company's ability to generate returns on shareholder equity, offering insights into how well the company uses its equity base to drive profitability. When analyzing profitability ratios, it is important to look for trends over the 3-year period for both ExxonMobil and Chevron. Are these ratios improving, suggesting stronger financial performance, or are they declining, indicating challenges in maintaining profitability? These trends will inform your strategic recommendations to the board, especially when considering whether to prioritize dividend payments, share repurchases, or reinvestment in new projects. In the context of ExxonMobil's strategic decisions, profitability ratios will help determine whether the company has the financial strength to pursue new opportunities, manage market downturns, or to return value to shareholders. Use these insights to support your recommendations regarding the company's future direction. Finding inputs for these ratios. You will need 3 years of financial statements for both ExxonMobil and Chevron to calculate their ratios. Be sure to search online for each company's annual reports for the past 3 calendar years. Links are shown on this slide to help you locate that information for both ExxonMobil and for Chevron. Be diligent in your search. If you don't find the information you need right away, take a step back, look at it from another angle, and try again. The information is out there. When analyzing financial ratios for ExxonMobil and then comparing them to those of Chevron, it's essential to move beyond simply calculating these numbers. The real value comes from interpreting what the ratios reveal about each company's financial health and strategic positioning over time. Let's break down an approach you should take when working through this information. Step 1. Construct a ratio table. Begin by constructing a table that captures the key financial ratios for both ExxonMobil and Chevron over the past 3 years. This slide provides a template to organize the data for each category of ratio: activity ratios, debt ratio, and profitability ratios. Having a visual representation of these ratios allows you to see trends more clearly. For example, are there consistent improvements or declines in certain metrics? This format also facilitates comparisons between ExxonMobil and Chevron, highlighting any competitive advantages or challenges. Step 2. Go beyond calculation. Instead, analyze, summarize, synthesize, and explain. Do not stop with simply calculating the ratios. A common mistake is to treat ratio analysis as a purely quantitative exercise. The goal is not just to present the numbers, but to derive constructive insights from them. Focus on analyzing the trends in the ratios over time. For instance, if ExxonMobil's debt ratio is decreasing while Chevron's is increasing, what might this indicate about each company's approach to managing financial leverage? Are they prioritizing debt reduction or perhaps taking on more debt to finance new projects? Summarize the key findings from your analysis. What do the ratios suggest about ExxonMobil's liquidity, efficiency, debt management, and profitability when compared with those of Chevron? Look for patterns or significant shifts over the 3-year period that could have strategic implications. Be sure to explain in great detail what these insights mean for the company's future direction. Consider how changes in these ratios align with shifts in ExxonMobil's strategic priorities, such as transitioning to clean energy or maintaining strong dividend payouts. For example, if profitability ratios have improved, does this support a strategy of increasing shareholder returns through dividends or through share buybacks? Step 3. Relate the analysis to strategic decisions. Use your ratio analysis as a foundation for your recommendations to the board. For instance, if the analysis shows strong liquidity and profitability, you might argue that ExxonMobil is well positioned to invest in new technologies or to expand clean energy initiatives. Conversely, if the analysis reveals weakness such as high debt ratio or declining operating margins, it may suggest the need for a more conservative approach, focusing on debt reduction or improving operational efficiency before taking on new projects. This comprehensive approach ensures that your analysis is not only accurate, but also actionable, helping the board make informed decisions based on the company's financial condition. Remember, your role in this project as the CEO is to interpret these financial metrics in a way that provides strategic value. Simply stating the ratios is not enough. Explaining what they mean in the context of ExxonMobil's competitive environment and potential future strategies is what will make your analysis and leadership stand out. To help you with your research, here are a few references to some relevant articles. Be sure to properly list and cite your references according to APA style 7th edition. And of course, check the announcements where you can download the slide deck, making it easier to locate these references. This concludes Live Chat Part 2 for week number 4. Remember, the course ends next Sunday at exactly 11:59 p.m. Eastern Time. No late assignments can be accepted after that date. Do your best work, and I'll see you online.